How come institutional traders and retail traders trade different? Mostly retail traders, they learn from other retail traders. They go on YouTube, they go read all these books that are written by people who are not really professional traders, and then they commit the same mistakes over and over and over again, and it's like blind leading the blind. So one of the tricks that nobody talks about on YouTube is called a starting position or a feeler position. Now, all these yahoos in Telegram groups and these 20-year-olds on YouTube, they talk about sniper entries and all that bullshit. Oh, I caught the top, I caught the bottom, this, that. Anybody who has been trading for over a few years, they should be laughing at this. Why? Well, because it's all ego driven. You see, whenever you're celebrating the, oh, I caught the top, I caught the bottom, your ego is involved. The trading becomes about being right. And trading is not about being right. If you're going to be trading thinking that you have to be right all the time, this is a recipe for a disaster and a blown account. 100% guaranteed. That's a fact. Why? Well, because if you have to be right all the time, and trading, even the greatest traders in the world are not right most of the time, right? The greatest traders in the world may be right 80% of the time. I'm talking about years and years, over and over and over. You're an excellent trader if you're 60-70% of the time right. And then obviously you manage the risk accordingly, so you have 2-to-1, let's say. A risk to reward at least 1-to-1. You make money. So trading is a business about making money. It's not about your ego. It's not about being right. So whenever you see all these gurus talk about sniper entries and catching tops, bottoms, and all that, that means they're still emotionally attached to the fact that they need to be right. They need to prove something to the market, when the whole thing is about making money, not about you stroking your fucking ego, okay? So whenever all these retail traders talk about entering trades, they usually enter trade all at once. 100% in, and then 30 pip stop loss or something like that, and that's it. Win or lose, that's done. And institutional players actually approach this completely differently. Yes, some people enter in one shot at certain opportunities, but more often than not, they start what's called starting position or a feeler position. Why is it called a feeler position? Well, have you ever noticed whenever you're just watching the market, you're just watching the market. But whenever you have a trade on, your senses are a lot more sharper. Your intuition is following the market. You feel market a lot better. That's why it's called the feeler position. So you start the small position size. It's only there to sharpen your senses. It's not there to make money. So your starting position makes you be more involved in the trade. And once you're in the trade, in the market, that's when you start feeling the market a lot better, which allows you to pinpoint the accurate time and place a lot better to enter a bigger size position. So what's a feeler position? A feeler position is something very small. It's 1/10 of your normal size. There to just fluctuate a little bit. You don't put a stop loss on it. Obviously, if something drastically changes in the market, you will close the position. That's why it's more for professional traders and not for somebody who just started trading and they're never going to close it and they're going to create a problem. It's more for somebody who has some self-discipline and they can close the position size. And before I get roasted for not using some kind of stop loss, there's always a stop loss. You just don't put a hard stop loss. It's a small position size to just gauge the market. Once you're gauging the market, because now you have skin in the game, now you're involved in the trade. It's sort of the same way when you're demo trading versus real money trading, right? With the demo trading, you're always the boss, a billion here, a trillion over there, no problem, yada, yada, and they actually even work out. And when you have real money in the game, most people start shitting pants and stuff, right? So same thing here. Once you have skin in the game with a small feeler position, it's just enough to give you that sense of you smell what's cooking in the market. And when you have your senses to the point where you actually feel the market a lot better, you can see the spot where you should be entering with a larger position size a lot better, rather than just, let me just go one shot with the whole position size. Have you ever been in a position and you just see something, market trading, and then you're like, oh, you feel that this is the moment where something is about to happen and it just happens? That's why you have to put a feeler position size. Obviously, if you've been trading for 2 months, this is not for you, okay? I'm talking about more advanced type of traders who've been in the markets and who have some experience under their belt. This is how institutional players, they start the position, they build the position, and then they can exit, scale out of it or scale in more. Now you start building the little position size just to gauge the market, and you're not sweating bullets and once you see the proper opportunity develop, that's when you strike with a bigger position size, because you've been observing market, having skin in the game for an extended period of time. Your probability of entering in the right time, at the right place, in the right spot increases drastically. This is one of those tricks that institutional or professional traders use to enter into positions, and they rarely enter in one swift go, in one big lump. They usually chunk it up. But again, if you're going to be chunking up any position, and you have to obviously still manage the risk accordingly. Don't start a position you're down 2, 3, 5% and then add another position and another. No. A feeler position, you obviously have to understand that the trend is going into some direction. You're going with that direction, and you're just starting a small position size to understand that, oh, let's say euro dollar is in a daily downtrend and there is a pullback happening on the shorter time frame. So you start your feeler position to see if the pullback is over, it's not over, and you start gauging and tracking the market a lot better to see when the trend resumes downtrend, for example. That's when you go for the kill with a bigger position size. All right, I hope this helps. As always, FundingTraders.com. My door is always open. With gold hitting all-time high, we're trading live multiple times a day. We're going on live on our Discord with hundreds of people watching and exchanging ideas and advice. So more than welcome to join us and check us out at FundingTraders.com.